Oil explodes to $150 a barrel. Global markets drop 8% in a week. Shipping insurance triples overnight. Airlines scramble to hedge fuel, and governments rush to emergency meetings. This is how a US-Iran war would begin to shock the global economy. Not slowly, not quietly, but instantly. Because this isn't just a military conflict. It's an energy shock, a trade shock, a financial shock. And in a $100 trillion global economy, shocks spread fast. In the next few minutes, you'll understand why one narrow waterway controls 20% of the world's oil, how inflation could surge back above 6% in major economies, why stock markets could erase trillions in days, which countries face economic collapse first, and what the global economy might look like if this conflict drags into 2027. This isn't about politics, this is about money. Let's break it down. 1. The strait that powers the planet. At the center of everything is the Strait of Hormuz, a narrow waterway only about 21 miles wide at its tightest point. Every single day, around 20 million barrels of oil pass through it. That's roughly 20% of global oil consumption. Iran sits directly along this choke point. If war escalates and Iran disrupts shipping, even partially, oil markets would panic. Right now, oil trades around $80 per barrel in stable conditions. In a serious military confrontation, analysts estimate oil could spike to $120, $150, even $200 per barrel if tankers stop moving freely. For perspective, when oil hit $147 in 2008, global inflation surged and the financial system cracked under pressure. Energy isn't just gasoline, it powers cargo ships moving $25 trillion in annual trade, airplanes flying 4 billion passengers a year, factories producing everything from steel to smartphones, farms feeding 8 billion people. If oil doubles, transportation costs surge. If transportation costs surge, everything gets more expensive. Every $10 rise in oil can add roughly 0.3 to 0.5 percentage points to global inflation. If oil jumps $70, that's potentially 2 to 3% extra inflation, and the world is not ready for that again. 2. Inflation returns. Hard. The global economy just fought a brutal inflation battle. Interest rates in the United States climbed above 5%. Mortgage rates doubled. Borrowing became expensive. Growth slowed. Now imagine fuel prices exploding again. In the US, gasoline could move past $5 per gallon. Diesel, the backbone of trucking, could surge above $6. In Europe, already dependent on energy imports, natural gas prices could spike 50% or more. India imports nearly 85% of its crude oil. If oil jumps $50 per barrel and stays there, India's annual import bill could increase by $70 to $90 billion. That weakens the rupee. It increases inflation. It pressures government budgets. Japan and South Korea face similar exposure. And when energy costs rise, food prices climb, airline tickets increase, shipping costs surge, manufacturing slows. Suddenly, inflation isn't 3%. It's 5% or 6%. Central banks would face a nightmare: raise rates again and risk recession, or tolerate higher inflation. Either choice hurts. 3. Stagflation, the 1970s scenario. There's a word economists fear: stagflation, slow growth. High inflation, weak job creation. The last time oil shocks triggered stagflation was the 1970s. Growth collapsed. Inflation soared into double digits. Living standards stagnated for years. If oil sits above $150 for months, global GDP growth could fall by 1 to 2 percentage points. In a $100 trillion global economy, that's $1 to $2 trillion in lost output. Entire national economies wiped from growth projections. Businesses delay investment. Consumers spend less. Unemployment rises. But prices don't fall. That's the trap. 4. Stock markets. Trillions at risk. Markets react fast. In the first week of a major escalation, global stock markets could drop 5 to 10%. That's trillions of dollars in erased value. Energy companies might surge, but airlines, shipping firms, manufacturers, retailers, they get squeezed. Fuel is one of the largest expenses for airlines. If jet fuel jumps 40%, profit margins disappear. Investors flee to safe assets. Gold could surge above $2,500 per ounce. U.S. Treasury bonds rally. The dollar strengthens, emerging markets suffer the most. Countries with heavy oil, import dependence, and high debt, like Pakistan, Turkey, Egypt, and Argentina, could face currency crashes. When currencies fall, dollar-denominated debt becomes more expensive. That creates debt crises. A regional war turns into a financial contagion. 5. shipping chaos, and insurance shock. Oil isn't the only thing flowing through the Gulf. Liquefied natural gas shipments from Qatar move through the same waters. Europe relies on LNG imports after cutting dependence on Russian gas. If LNG shipments slow, European energy prices spike again. Electricity bills surge. Industrial production slows. Fertilizer prices rise. Food prices follow. Shipping insurers would immediately raise war risk premiums. Insurance costs for vessels in conflict zones can jump 20% to 50%, sometimes even double. Shipping companies may reroute around Africa. That adds weeks to delivery times and billions in extra fuel costs. Every added cost flows to consumers. Your electronics cost more, your clothing costs more, your groceries cost more. Global supply chains, still fragile after pandemic disruptions, would strain again. 6. Defense spending explosion. War is expensive. The United States already spends over $800 billion annually on defense. A direct conflict could push emergency spending tens of billions higher within months. Missiles, naval deployments, air operations. None of it is cheap. Iran's military budget is much smaller, around $20 to $25 billion annually, but escalation could draw in regional actors. Saudi Arabia, Israel, the UAE. Military spending across the Middle East could surge by $50 to $100 billion collectively. More defense spending often means more government borrowing. More borrowing pushes up bond yields. Higher yields mean higher mortgage rates, higher corporate borrowing costs, and slower economic growth. 7. Oil exporters. Win at first. High oil prices aren't bad for everyone. Oil exporting nations benefit initially. At $150 per barrel, Saudi Arabia's oil revenues could exceed $1 trillion annually if production stays steady. Russia would also gain financially. Even U.S. shale producers would see profit margins expand sharply. But here's the twist. If high prices trigger global recession, demand eventually falls, and oil prices crash again. Short-term winners can become long-term losers. 8. China and Europe, the big importers. China is the world's largest oil importer. It imports over 10 million barrels per day. A sustained $50 increase per barrel could cost China an extra $180 billion per year. That pressures growth. It weakens industrial margins. It reduces export competitiveness. Europe faces similar vulnerability. After the Russia-Ukraine war, Europe already experienced energy-driven inflation spikes. Another shock would test political stability. High energy bills fuel public anger. Public anger fuels instability. Economic stress becomes political stress. 9. Could the strait actually close? Closing the Strait of Hormuz entirely would be extreme, but even partial disruption creates panic. If 5 million barrels per day are delayed or threatened, markets react immediately. Strategic petroleum reserves could be released. The United States holds roughly 350 million barrels in reserve, but at global consumption levels of 100 million barrels per day, that's only a temporary buffer. Reserves buy time. They don't solve prolonged war. 10. The long-term shift. If conflict drags on, the world accelerates diversification. More renewable investment, more domestic energy production, more strategic reserves, more supply chain reshoring. But transitions take years. The short-term shock would be immediate and painful. The real question, a US-Iran war would not remain regional. It would move through oil markets, through inflation, through stock markets, through currencies, through household budgets. The global economy is deeply interconnected. When 20% of the world's oil flows through one narrow passage, stability becomes fragile. The question isn't whether markets would react. They would. The question is, how long would the shock last? How high would oil climb? And how much damage would it leave behind? Because economics isn't just data, it's leverage. And in a world powered by energy, whoever controls the choke points influences the system. If conflict erupts, the impact won't be measured only in missiles. It will be measured in prices, in growth, in trillions of dollars, and in how resilient the global economy truly is.